Welcome to another episode of The Financially Free Investor, where you will learn information and strategies on how to become financially independent by investing in real estate, something that is not taught openly in our society today. Financial freedom matters so you can live a bigger life, retire early, and do what matters most to you. Get ready to hear tried and true methods to becoming financially free with your host, Jordy Clark.
Hey everyone, welcome into another episode of The Financially Free Investor. Today, I'm super excited about my guest. I'm excited about every guest I bring on, but especially this one. So just a quick little introduction. Josh Mettle and we actually met through some mutual friends, the Marchants, and we spoke together on a panel to a bunch of other investors or aspiring investors and real estate agents. And I was just super impressed with everything Josh had to say. We really clicked, and I wanted him to dive deeper on something that he touched on. We gave a little presentation, and so here we are. Josh owns a mortgage company. He invests in a ton of different real estate. He's a phenomenal guy. He's got an awesome sense of humor, awesome family, and yeah, he's just a awesome guy. So Josh, welcome in, man.
Oh, no pressure, Jordy. Thanks for the intro, man. I appreciate the kind words. And I really had a blast at that presentation we did together. And I found that your thinking and how your teaching in your presentation dovetailed exactly in what I believe and what I was thinking too. So I'm excited to spend a little time together, and I'm excited to inspire some people together this morning.
Yeah, no, that's awesome. Well, Josh, maybe let's jump into who you are and your journey as a real estate investor. It's hard to maybe collapse the last 20 years into 5 minutes, but maybe just give us an idea of your journey, because I think there's a lot of value in that as we just learn from other people. Kind of hearing their story gives us a good background for them. So.
Learning from other people's mistakes is so much better than learning from your own mistakes, isn't it? So 22 years ago, my mother and I decided to start investing in real estate, and we were going to be flippers. And so, the first property that we bought was a condo in Sugar House, and it was a bank-owned property. And by the time we closed escrow and then finished the renovations, which was, maybe like 90 days or something like that, there'd been 4 other bank-owned properties. So we were in this property, I think about 115,000 or so. And for us, that was a lot of money. We'd saved every dollar that we put into that property. We weren't wealthy people. We were taking a big risk. This was a serious deal to us. And by the time we finished the renovation and went to start to market the property, there were bank sales at 92, 87, 85, 83. And we were like, we're 35% upside down. We'd spent 6 months trying to find a property. Of course, we weren't using a realtor. We didn't have anybody to coach us. We didn't have a team. We didn't have any of the things that would have made that a lot easier and a lot safer. We were just going to do it all ourselves. And as a byproduct of that, we got to learn all the lessons ourselves. And so we said, well, what are we going to do? And we said, well, we're not going to lose 30, 40, 50 grand on our first investment. So what if we just try to rent it out? So we rented it out. We ended up refinancing the debt off of that, which was lent to us by a family member. We left all our equity for improvements in there. We had our first positive cash flow property by like $37 a month, but it was positive, damn it. And we said, all right, well, now it's time to go make a bunch more money, and we'll try this flipper thing again. Well, Jordy, some version of that story happened about 5 more times over the next 3 years. And, it was, literally we joke now, if you wanted to know where the real estate market was about to collapse, just find out where Josh Mettle bought a house, because for sure there was a freeway going to be announced there, or, all the roofs in that area were being to be replaced. It was ridiculous, our string of luck. But what came out of that is that we realized, we turned around in a couple of years and we went, we've got 5 properties that are all positive cash flow. Now, this is before anybody talked about the BRRRR method. Like, I've never heard that method, but as Jordy said, we met through some mutual friends, the Marchants. This is actually a process that they've been doing incredibly successful for years. And at the time, I think they had, 30 or 40 homes, and they were buying with somebody else's money, doing the renovations with their money, renting the property out, and then refinancing and paying off the private money, and sometimes even getting some of their renovation money back. And then they created a positive cash flow, and then they'd rinse and repeat. So by accident, truly dumb luck, we found, more dumb than luck, actually, we found the BRRRR method. And we just, we were just so damn determined, Jordy. We were like, well, we're not going to give up on this thing. We're going to find a path. And it took us 3 years to find that path. And our path was that we were actually really good at renovating properties, renting properties, maximizing their economic value, managing those properties, picking good tenants, creating cash flow. We were just horrible market timers. And that was one of my, very first real lessons was, it's not, the magic isn't in timing the market. The magic is time in the market. And as I look back on that very first condo in Sugar House, we still own it today, right? When we started renting it out, gosh, I'm going to guess we rented it out for, I'm kind of just going off loose memory here, but I'm going to guess, Jordy, the rent was about $400 a month. It's just a 2-bedroom, 650, 700 square foot condo in Sugar House. It's nothing crazy. Today, we've paid off the debt and it rents out for $1,500 a month. And you go, okay, well, the magic certainly wasn't timing the market, because we did everything wrong and started 30, 40,000 upside down. The magic was time in the market. And that's really been, as I reflect back on 22 years of investing, that's really been amazing for us. I'll tell you just one more quick anecdotal story around time in the market. A few years after we bought our first couple of single family or condos, we 1031 exchanged a couple of those properties into an 8-plex on Capitol Hill. And we bought that property literally 20 years ago. We paid $315,000 for 8 units on the side of Capitol Hill. These are big 2-bedroom covered parking, 850 square feet, and they have a view of the Great Salt Lake, and you get to see all the sunsets. Like, they're pretty freaking cool. And the rents on those properties were going for about $275 to $315 a unit per month. So call it was bringing in $2,400 a month in income, and maybe $30,000 a year. And we paid $315,000 for it. Not a bad deal. But our mortgage payment was $2,000 a month. So, or $1,800 a month, right in that range. So 85% of our income-ish was going to pay for the mortgage payment every month. That was, just barely making it. I think we were $25 a door positive if we didn't have a major capital improvement project. Well, fast forward, Jordy, 20 years later, my mom and I did a 20-year anniversary party for that property, where we just got together and celebrated with like a bottle of wine and just kind of talked through it. And we got out a piece of paper and we wrote down all the numbers. And we were like, could you ever have imagined 20 years ago that the rents on those properties, we'd be renting those at $1,500 a month? And so now, you've got 8 units. We're bringing in $12,000 a month in income. And if we still had the mortgage, which we don't, but if we did, we would have refinanced it to a lower payment, right? Like, maybe we would have been paying $1,000 a month after refinancing it. So if you think about it, over 20 years, it brings in $12,000 a month. We maybe would have had a $1,200 a month mortgage. So if you look at the income to mortgage ratio, we bought the property with 85% of our rental income going to pay the mortgage. 20 years later, 10% of the rental income pays the mortgage every month. And ultimately we just made a decision to pay it off. But I think that's probably like the most profound lesson in investing that I've only been able to learn or fully comprehend after 2 decades, but I never would have imagined from the start line going forward.
Dude, that's such a good story. I want to go deeper on that because I think that's something that people forget about, right? Because every deal I've bought, the day I buy it, I'm like, holy cow, am I making the right decision? Like this thing barely cash flows. And again, for anyone that's listening outside of the, greater Salt Lake area, we have a couple of factors that are causing, I'd say, maybe higher than average appreciation in both rents and price.
Yes.
And that fact is we've got major geographic boundaries. Like, Salt Lake's at about 4,200 feet above sea level. And then to the east of us, we've got some mountain ranges that go all the way up to, 13,000, 14,000 feet on some of the peaks. And it's a very dramatic, if you're somewhere from the Midwest, it's very dramatic that you fly into Salt Lake and it's literally just a valley with a huge mountain range on one side, a slightly smaller mountain range on the other side, and then we've got massive lakes. And so geographically, like we only have so much land, which I think is going to cause, us to continue to have good appreciation because there's a scarcity. We also have a ton of people moving from other states for a variety of reasons. But anyways, I'll hop off that soapbox and jump into your, last 2 decades, because I think this is really important for everyone that's just starting out to learn and get the picture, because every property, and I'm sure when you guys bought the 8-plex on Capitol Hill, you were like, oh, I don't know, this is really expensive. It doesn't really cash flow. But you look on a 10, 20-year horizon, and every property I bought 5 years ago, I'm like, holy cow, why didn't I buy 5? Why didn't I buy 50? Right? But every time, and especially today, we're sitting in September of 2022, interest rates are going up, property values, no one knows what's going on. We don't know where the market's headed. There's a lot of uncertainty and reasons not to invest. But if we look at a 20-year horizon, talk to us about kind of, this leads into the what do you call it?
Yeah, the inflation destroys debt topic.
Yeah,
Yes.
yeah, exactly.
Yes.
So maybe jump in and give us your take on that.
Well, I want to comment just really quickly about your comment around every property that I purchased. There was that pause when your hand reaches out to open the title door and you're like, should I be doing this? should I push through the door to go close the property, or should I turn around? I was having a conversation with one of our partners, and we were in one of those moments where we were going, man, this is right on the edge. We're going to have cash flow, but it's right on the edge of what seems to make sense to us. And I said to him the same thing that you just articulated was, I just said, bro, do you ever remember buying a property where you didn't think you were overpaying? And he goes, no, I don't. And I'm like, okay, so we got to get past that. And then we have to think through, does it cash flow? Is the debt on it reasonable? Are we in a good area where we think we're going to see appreciation and continued rent rises? And are the headwinds or the tailwinds stronger? Meaning, is there more things going to push rents down, or are there more factors going to push rents forward and up? And so I think that's just one of those things from a fear standpoint that we have to compartmentalize. We can't ignore. Like we need to write those things down. Like get out the notepad and go, shit that can go wrong and things that can go right. And we need to really go through those things and make an analytical decision. But once we go through our analysis process, we can't let the fear paralyze us, because I was so afraid at that moment buying that $315,000 building, which we 100% financed, by the way. It was just incredibly fearful, but I knew we had cash flow. I knew we could raise the rents. I knew what was happening. Well, I didn't really know what was happening in Salt Lake, but I thought I had an idea. It was way beyond where I thought it was going in Salt Lake. But I want to show you just one thing that, to your point, Jordy, about Utah being a very special place in terms of appreciation and i.e. rent growth as well. This is a website that I subscribe to called MBS Highway. And this shows, for those of you who are listening, this shows the change in home values across the United States, cumulative appreciation since 1991. So we're talking 30 years-ish. And if you look at the entire nation, the national stock of homes has gone up 292% since 1991, roughly 300% in 30 years. Incredible. It's absolutely incredible. What that means is that your house is going to go up 100% about every 10 years, which is absolutely incredible. But my friends, to Jordy's point, if you looked at Utah has been the fastest appreciating state in the country, up 599% in 30 years, which is just really unbelievable. So actually, there was a fault in my numbers. That wouldn't mean that your home doubled every 3 years, because if that was the case, that would go from 1 to 2 and from 2 to 4. So I might have exaggerated that a little bit. But 300% appreciation in 30 years is still pretty incredible. But here's the thing that people don't think about, Jordy. Rarely do we pay cash for properties. We use mortgages. And those mortgages provide us leverage. So if you look at a piece of real estate that's appreciated 600% in 30 years, but you only put 5% down, that means you got a 20x leverage. So what's 20 times 600? Because Utah is appreciated at 599.2% over that period of time. That's a 12,000% return on your investment. And so when you hear a stat like, the 2/3 of the amount of wealth in the United States is real estate equity. So you take stocks, bonds, cryptocurrencies, businesses, all that wealth. Well, 2/3 of the wealth in the United States is real estate equity. And so, like Jim Rohn said, success leaves clues. If somebody can put 5% down and then be patient for 30 years, and you were lucky enough to live in a state like Utah and see a 12,000% return, you don't need to buy that many properties to end up pretty damn comfortable in retirement. So I think that's important for people to understand, and I think it puts an exclamation point on your comment, Jordy. Anything you want to add before we kind of go on to this inflation destroys debt topic?
No, let's jump in. I'd love to hear and let our listeners hear on more of this, because I think, and I was just talking to a buddy about this yesterday. So often in our society, we're taught a few things, and we're taught, pay extra on your home.
Yeah.
And, go to school so you can get a good job. And,
Yeah.
A lot of this stuff, it may be true for some people, but it doesn't have to be for everyone. Right. And especially the, avoiding debt. I do think, you shouldn't live on credit cards and live beyond your means. You definitely need to figure out how to go from being a spender to a saver to an investor. But once you kind of get past that threshold and you're like, okay, I'm going to invest. There's so many people who are like, hey, I'm going to put this on a 15-year mortgage. Well, okay, that's great, but why? And you kind of go through these things. But yeah, let's jump into the inflation erodes debt conversation.
Yeah, to your point, Jordy, I think that's a really good gate that we can go through on the way to the inflation destroys debt. There's a book by a guy named Garrett Gunderson called Killing Sacred Cows, and he's a Utah guy. And it's killing sacred cows, overcoming financial myths that are destroying your prosperity. That's the subtitle. And basically what he's talking about in that book is exactly what you just said, Jordy. Look around at the average net worth and the average income of America, because those people are taking the typical standard investment advice. As you said, go into debt, get highly educated, go work for somebody else, put all your money in the hands of Wall Street, who's going to, protect you and put those in index funds. And I'm not saying that you can't get to a place of wealth that way. If you're highly educated and you live below your means and you save 20 to 25% of your income and you invest it in index funds for 40 years or 50 years, you're going to be just fine. But if you look at the success rate for people who pull that off, it's not that great. What happens is people go to school, they accumulate a ton of debt, they don't make as much money as they'd hoped, inflation erodes their buying power, they overspend, they buy the new car before they get their next raise, they go 30 years and look back and go, oh crap, I'm at almost the end game and I haven't started my preparation. So to your point, I just encourage people to question all of that. Like, is that financial doctrine that we're being taught creating a future that I want to play in, or is the future that's creating for most people not a place that I want to be when I get there? So for me, that was real estate, right? I wanted to control it. I wanted to raise rents. I wanted to have agency over what I did with my property. And I wanted to be able to go out and put my hands on my building and know that it was there. So one of the things in this journey that we're talking about here, Jordy, that has been maybe the most surprising thing for me is this concept around inflation destroys debt. And once you get this concept, you never want to pay off debt, because you realize that inflation is doing that for you. And what you want to do with your extra capital is buy the next asset that you can improve and rent and raise the rents that's going to beat inflation. Because what inflation is a dilution of dollars. Now, here's where the problem begins. People think that dollars is a static measuring unit, like a foot. Like if I look across my room here, Jordy, I've got about 16 feet in depth to this room. And if I come back in 100 years, how many feet is it going to be across this room?
Same.
16.
Yeah.
It's static. It doesn't change. But if I give you $100 100 years ago, you probably could have bought a house, or a bunch of horses. Today, we're going to get, a picture frame, a couple of knickknacks. Like that piece of glass over there costs more than $100. So what people first need to understand is that when you look at a dollar, it is not a static measuring unit. It is a measuring unit that is getting smaller and smaller and smaller and smaller year after year. So if I get to borrow $1 when it's worth this much, for those of you who can't see me, this is about 2 feet apart. And if I get to repay it 30 years later and it's worth this much, 2 inches apart, I want to spread that debt payment out as far as possible because the dollar is being devalued. And I have some illustrations that I'll show for those of you that are, watching the video. But I want to bounce back and forth between teaching you the theory and then giving you the practical example. So before I go into this, what I'm going to show you, go back to the illustration I talked about on the 8-plex. When I bought the property, 85% of my income was going to pay the mortgage. The rents were $2,400. The mortgage payment was like $1,800-ish. So somewhere around 80 to 85% was going to cover those expenses. Fast forward 20 years later, there's $12,000 of income coming in. And that mortgage payment, even if I wouldn't have refinanced it to lower interest rates, let's just say it was down around, $1,800 per month. Now I have going out only 15% of my income is going to that mortgage. So one way you could say it is the income went up. Yes, that's one way to look at it. But the other way to look at it is the inflation that pushed the rents up devalued the debt, because there's actually, as a percentage basis, there's a smaller percentage of the monthly income going to service the debt. Does that make sense?
Yeah.
Okay. Yeah. So now let me show you that with some, did you want to comment on something there, bud?
No.
Okay.
Go.
Cool. So I'll show my screen and I'll try to be, I'll verbalize this as much as possible for those that are watching the podcast. So this is just some recent data out of Zillow. And, what most people think about is the left column, which states that, there was 18% real estate appreciation from it would have been, I guess, August of 21 through the end of July of 22. And that took the average home price in America up to $355,000. So most people think in terms of home values. Well, I have a ideal investment timeline of 100 years, meaning I want to keep properties for as long as humanly possible. And I hope to teach my kids that they should keep their properties for 100 years so that they can leverage this idea that inflation destroys the debt on properties. So I don't pay attention to the appreciation as much as I do as the increase in rent. And Zillow also publishes that the average US typical monthly rent is now up to $2,000, $2,031 a month, and it's up 13.2% year over year. And so this is what I think is the most powerful thing in real estate is the rents go up because inflation is pushing up those rents, but our mortgage payments stay the same, or in times we go into recessions, you can refinance those down to even lower rates, which I think there's an opportunity in our near future to probably do that. So this screen, Jordy, has a lot of numbers. I'm going to try to verbalize it the best that I can, but this is a case study on a 30-year payback of a mortgage. And it goes to that point of why I never want to prepay a mortgage unless I'm, in my case, I paid off a first mortgage so that I could open up a line of credit so that I could use that for another investment on my 8plex that I mentioned about. So this shows a house, the average home value in 1972 was $18,267. If someone put 20% down, their mortgage would have been $14,614. By the way, that was really the average home price in America in 1972. It was $18,000. The average mortgage rate that year was 7.37%. They did a 30-year loan in this case study, and their mortgage payment was $100.88 per month. Now, we're also going to assume that this person has a 33% tax rate because we're going to factor in some tax deductibility of the interest. And then we start out in 1972. This column shows that from 1972, and then the home was paid off in 2001. So we've got a 30-year loan. The next column over shows the inflation rate for each of those years. Now, here's what inflation does. It devalues the dollar, but as a result, wages, meaning if I'm a W-2 employee, my wages are going up. If I'm a self-employed person, the products that I'm selling to you, the cost of those products are going up. And if I have a rental property, rents are going up. So as the dollar gets devalued, more dollars come in the front door in terms of wages, rents, or items, commissions from what you're selling. So this tracks our inflation rate from 1972 to 2001. And then the next column says, okay, well, then what happens? What's the inflation adjusted value of the dollar? Well, when they took out the debt, a dollar was worth $1 in 1972. So we had a full $1 value in 1972. But if we fast forward over 30 years, the value of that dollar in 2001 was only 23 cents. So we only had 23 cents of purchasing power 30 years later. And then this goes on to show, hey, here's the actual, what's called nominal payments. This is the actual, nominal means name alone. So when we say $1 is the same in 2022, well, it was still $1 in 1922. So in nominal terms, $1 is $1, that's the same thing. But in real terms, in inflation adjusted terms, the dollar's worth a heck of a lot less in 2022 than it was in 1922. So this shows the annual mortgage payments over 30 years. The person paid $36,000 to pay off that mortgage. That's the principal mortgage amount of $14,000 plus interest over 30 years. They repaid $36,000 in name alone. Because remember, in my illustration around feet are constant. I have 16 feet across my house. dollars are getting smaller. So in name alone, they paid back $36,000. But if you adjust for inflation, they didn't pay back.
Can I stop you right there?
Please, yeah.
I think it's important to point out that, you know, when someone bought that house in 1972, they paid $18,000 for it. Their mortgage amount was $14,000. And a lot of people, they just think about what they're paying the bank. So they would go, hey, I borrowed $14,000 and now with interest, I'm going to have to pay back $36,000.
Yep.
Well, of course I want to pay this off as quick as possible.
Yep.
Right. So I want the listener or viewer, if you're on our YouTube, and guys on this podcast specifically because of his slides and how awesome they are, like go to my YouTube channel. We'll link to it in the show notes, but go check it out, because you can look at this and just looking at this chart, like you've been talking the whole time. And, you know, I have the benefit of having heard this before. Yet looking at this, I'm just like, holy cow, like I need more debt.
Totally.
So anyways, keep going. You started talking about the annual inflation adjusted payments, because I just wanted to sidestep that, because I think that's a common thing that I hear is, oh, well, you know, people focus on what they're paying the bank and what the bank is making versus what's happening for them. And I think it's more important to focus on what happens for you guys as the listeners versus like, who cares what the bank makes? What's more important is what you make. And these next two columns are going to go over that beautifully. So go for it. Sorry.
No, that was really valuable. You actually gave me a thought. If a dollar was constant, Jordy, like a foot, a yard, a mile is constant, then the thinking that you want to pay the debt off early actually makes sense, because, you know, in this illustration, there's $22,000 worth of interest that's being charged. And if that dollar value was constant, it would make sense to front load that and get out of that 22,000. But that doesn't tell the whole story, because dollars are not constant. And so this next column shows you, if you adjust the annual payments, it's $1,210 a year. If you adjust those for inflation over the 30-year period, you actually only pay back $16,000. So $20,000 of the debt was inflated away because your income went up with the rate of inflation over that 30-year period. And that's the thing, Jordy, you alluded to it perfectly. People think they should prepay because they don't realize that the value of the debt or the dollar they're paying back is getting smaller. So if I can borrow in feet and pay back in inches, I'm going to take that trade all day long. I want to do more borrowing. And that's what this illustrates. So in this column here, if you adjust for inflation, yes, you've actually paid back in nominal dollars, 36,000. But in inflation adjusted, what's called real dollars, you only paid back 16,000. But then it gets even better, because if you were able to deduct the interest, which not everybody can, if you're a W-2, it might make more sense to take standard deductions. But for self-employed folks or people who own rental properties and they itemize and they can write off their deductions or the interest, or if it's an investment property, you can write off the interest, then you've got your cost of repayment actually goes down to $12,000. So you borrowed $14,614, and over 30 years of using the bank's money, you actually only paid, after the erosion of the value of the dollar through inflation and through tax deductibility, you only paid back $12,000. So this next slide kind of summarizes it. And basically, just in sake of time, I'll just kind of summarize this for you. The actual interest rate on your note, what would be called your nominal interest rate, was 7.37%. Your inflation adjusted interest rate over 30 years was 1.06%, but your after tax inflation adjusted interest rate was negative 1.16%, because inflation adjusted, you only paid back $12,655 on a loan amount of $14,614. So it's actually paying you to take out debt and hold it for 30 years based on inflation and tax deductibility. And then we just, for those, go ahead, Jordy.
Oh, I just want to jump in here. And guys, if you're listening to this again, I just want to tell you to go back to my YouTube channel, because this concept right here is so contrary to what we're taught. And the problem is, we're probably taught it from our parents, who were taught it from their parents, who were taught it from their parents, when the currency system was different. So the rules have changed over the last 3 generations, and they're not the same now that they were then. And so it's not that, everything you've been taught is a lie, because it was true back then when inflation was not what it is. And I think it's only going to get worse. But it just goes to show, like, can you go back one more slide real quick?
You bet.
And really the point I wanted to make was, you said, hey, would I rather borrow in feet and pay back in interest or inches? And I think everyone listening logically goes, well, yeah, totally. But if you look at this chart, year 1, it's the same. Nominally, inflation adjusted, it doesn't change, it's constant, right? But the next year, you look at it, and instead of nominal payments of $1,200 a month, it's $1,139. And I think a lot of people, that's 12 months out of the year, that's 50 weeks working. And we get so focused on what's recent to us, the recency bias, that we go, well, gosh, I really just want to pay this off early. And so, you throw a few extra bucks in there. It's really not until, 10 years later in 1982 that all of a sudden you see that instead of $1,210 a year, you're really paying $524 a year. Right. And I think this is why it's important that people start thinking in decades, not days, because real estate is, in my opinion, and I'd love to hear your take on this, but it's not a get rich quick scheme. It's a get rich for sure, because having somebody else pay off your property, especially with rental properties, you put a little bit down now, even if it's 20%, it's still a little bit because you're leveraging 80%. But then somebody else pays that off for the next 30 years while the government continues to print money, and it goes up in value and rents go up in value. And all of a sudden, like your 8-plex example, what do you think that's worth today?
Oh, I think it's worth, we just had it appraised, actually. It's worth like 1.5 or 1.6.
Yeah. So you go, $1.5 million. And again, like inflation adjusted, it's probably the same, but there's some stuff that doesn't go up as much. Like cars certainly have gotten more expensive, but if you had $1.5 million in cash, you can do a lot with that today, lifestyle wise, if you wanted to retire, that tenants have paid for, right? So I just think it's important to kind of circle back, put a little bow on it, think in decades and not days. And then you can jump forward one more and talk about this.
I think your point was very well taken. I'm going to show one more slide after this that proves what you just said around that advice of paying off debt fast was probably good advice when, you borrowed in feet and you had to pay back with 11 inches. But if you borrow at a foot and you get to pay back in 1 inch, then that doesn't make sense to pay back. I want to circle back to one more slide. This is just basically what I did was I took the amortization chart, Jordy, and I just charted it. And I said, okay, for those people who were visual, in 1972, the annual payments on that debt was $1,210. But as we go through time, from the bottom left to the bottom right, as we go through time over 30 years, the inflation adjusted payments goes down. And so this just begs the question, like, why would we have want to paid off this debt here, right? Why would we want to pay it off when it's $600 per month inflation adjusted? We want to pay that debt off when it gets down to $300 or $200 inflation adjusted. So it just shows you that, over time, the value of the debt is devalued, and you want to spread that time horizon out for as much as humanly possible. There's one more thing, Jordy, because I thought your point was, absolutely spot on. I want to show you one more slide, which is the total U.S. monetary supply, that the total number of dollars in supply in the United States. And this is one of the reasons why inflation has completely gotten out of control, because you have a devaluation or dilution of the dollar that's happening here. So let me just hit from current slide. All right. So I'm going to walk through this again and try to verbalize it as much as possible. But this is the total U.S. money supply in trillions. And this map goes back to, or this chart goes back to 1959. And you can see from 1959 to, let's call it 2001, basically monetary supply, the number of dollars in circulation in the US economy, went from virtually zero to 5 trillion. So that took 42 years to get to 5 trillion. Well, in 2001, everything changed. I mean, it was actually on a pretty, a higher trajectory since really probably 78-ish. The trajectory started to steepen. But in 2001, the rules really changed, because what took 42 years from 1959 to 2001 in this chart to get to 5 trillion, well, it only took from 2001 to 2012, 11 years to go from 5 trillion to 10 trillion. So think about that. What took 40 years now only took 5 years to double the number of dollars in supply. But that's not even the scary part. We go from 10 trillion to 15 trillion, another 5 trillion in debt from 2012 to, let's call that 2019. So, now we're talking 7 years there. And then from 15 trillion to 22.4 trillion from 2019 to 2022, only 3 years. So we're now doing in 2 or 3 years, in terms of the increase in money supply, that took us 40 years, and from 1959 to 2001, I guess 42 years. So the knowledge that the value of the dollar is constant and that debt should be paid down rapidly came from this era of 1959 to 2001, which is where, probably most of our parents got their knowledge base and their understanding of money. But this chart shows, to your point, Jordy, the rules have changed. The dollars in circulation are exponentially increasing, which means the value of your debt is exponentially decreasing. And I'll end with a quote here, because I think this is important to understand. Anybody who doesn't know Milton Friedman, he's one of my favorite economists. You should go to YouTube and type in Milton Friedman inflation. He has 2 or 3 20 to 30 minute talks on inflation, and it'll blow your mind. Like, you're just like, oh my gosh, we knew that in the 70s, and the Federal Reserve is doing what? Like, this is insane. So Milton Friedman's quote is, it's a little wordy. I'll clarify it at the end. Inflation is always and everywhere a monetary phenomenon, in the sense that inflation is, meaning it exists, and can be produced only by a more rapid increase in the quantity of money than in output. So if you think about that for a second, what does that mean? If there's more dollars being created in the currency system, then there is products and services being created or built, then that is the only way that inflation can exist. And if you think about output in terms of housing, well, here's what happened to the number of dollars in the US system. The dollar circulation is going, parabolic. while the number of homes being built since 2008 have been deeply constrained. We have a huge hole, approximately 4 million too few homes were being built. So if you go, well, why did we see 300% increase in the cost of housing over 30 years? Because dollar circulation was going like this. And then after the Great Recession, the number of homes being built was this. So you had a more rapid increase in the supply of money and a decrease in the output of homes being built. As a result of that, home values went parabolic. And then you add on top of it a really super hot economy like Utah with geographical restrictions, and you have a perfect formula for a boiling pot of home values.
So the question that comes to my mind then, and maybe some of our listeners too, with all of that, like, isn't this just another housing bubble? Like, shouldn't I just wait to buy?
Well, the answer to that question is another 45-minute podcast. But the things that caused the Great Recession are not evident where we are today. And those things, if I'm to say them very clearly, are we had 4 million homes for sale at the peak of the Great Recession. Today, and I'm talking about nationwide, today we have 1.3 million. We also have about 30 million more households in 2022 than we did compared to 2007. So we have a lot more households that need housing. And I would argue that it's never been more valuable to be a homeowner because I'm working from my office and my kids are doing school downstairs. So the utility of a home arguably has never been greater since COVID hit. There's not enough supply. There's more demand. And the biggest difference, Jordy, is that the reason the signal to the market, the builders, to build all those homes that caused that oversupply was cheap, easy credit. No income, no asset. You don't know how to spell your name. You just got out of jail. No problem. We'll 100% finance you. That caused a confusion in the marketplace that builders took as we need to buy as much land as possible and build as fast as we can. Today, people actually have to have jobs. They have to have down payments. They have to qualify. It's a bit of a pain in the butt to get a mortgage. And that's because we have to prove a borrower's ability to repay. Not to mention, we don't have negative amortizing loans. Interest rates are mostly fixed. Balances are going down, not up on mortgages because we don't have those 125% equity lines. Like, all those factors collided to cause the Great Recession. And none of those factors are present today other than home prices are expensive. But home prices expensive compared to what? I just paid $5 for a tank of gas, $8 for organic eggs. Like, what isn't expensive? It's not. And I think people are looking at it the wrong way. Is it expensive, or is the dollar just diluted? And I would argue it's actually the former, and that everything feels expensive because the dollar's been diluted. That doesn't transfer to a housing crash. Those are two very different things.
Yeah. So everyone that's waiting for a housing crash to happen, probably not going to happen. We don't have crystal balls, but I would agree with your consensus there. So I've got two more questions, and then we'll probably want to put a bow on it just to be sensitive to your time. The first one is, well, three questions. First one's, why did you pay off your sugar house? It was a 2-bed, 1-bath property. And I guess we could correlate that to the 8-plex as well.
Yeah.
And then the second question is correlated. Like, when do you decide to refinance something versus paying it off? And then, what do you do with the equity? Do you tap into it? We'll kind of go there. Just your personal investment thesis.
Yeah. First of all, I didn't fully grasp this concept around inflation destroys debt over multiple decades. I could feel it and I could sense it by looking at our P&Ls, but I didn't have ownership of it and understand it the way that I did today. So that's the first thing. The second thing was I couldn't find anything to buy. And I was sitting on a bunch of cash that's sitting in the bank. And I'm like, if I can't find anything to buy, why don't I at least pay off the debt? I was started to think to myself, okay, if I can't find anything to buy that makes sense to me, then I should just invest in my properties and increase their values and their rent so that I can create more rental income from properties that I buy. So we spent a couple years doing that. I still couldn't find anything that I really loved. And one of the reasons for that, Jordy, was I was really focused on apartments, and I just couldn't find anything that made sense to me. I eventually went outside of that office class and started buying retail buildings and medical office buildings, but I couldn't find anything to buy. The money was just sitting there. And finally I was just like, just pay the dang things off. We'll worry about it later. In hindsight, I maybe would have played that game a little bit differently, but I wanted to also get an equity line, and they wouldn't do it in second position. So that's just the way the cards kind of unfolded. And I think that's pretty much the same story for the condo. I just couldn't find anything else to invest in. I was trying to increase my cash flow.
So when do you decide to refi or pay something off?
Yeah, well, with my current knowledge, I can't really see a time where I would be paying, where I would say I want to pay off long-term solid debt, unless it had some kind of a nasty feature to it that I didn't like. I think that there is going to be a very good opportunity sometime in the near future. I don't know if it's 3 months or 3 years, but we are going to end up in some sort of an ugly recession at some point. And people think, well, recession equals housing crash. Not true, not correlated, actually reversely correlated. It has an inverse correlation. If you look at the last 6 recessions, going back to the late 70s, 4 of them had housing prices go up from the time we entered the recession and ended the recession. I think it was the 82 recession that housing prices went down 1.9%, which is just not significant. And it was only the Great Recession where we saw a double-digit devaluation or depreciation in housing. And people go, that doesn't make any sense. If people are losing jobs, how is it that housing prices go up? Well, it's because what happens in a recession is interest rates go down. So all the people who were sitting on the sidelines as renters are now reevaluating, hey, with a 4% interest rate or a 3% interest rate, now maybe it makes sense to get out of this rental that keeps going up in payments every year and go into the housing market. So because interest rates are going down, affordability is going up, and that brings buyers into the real estate market. So personally, what I'm waiting for is I'm waiting for the next recession. I plan to refinance all my properties that don't have significant prepayment penalties on it. We've raised the rent so much, I'll probably be pulling out cash from a bunch of those properties because the rents have gone up so much, it should support it no problem. And then I'll deploy that cash and go buy another property at that point.
So good. What is one thing you would tell someone who's working towards financial freedom?
Oh, be patient. We talked about this a little bit at the mastermind group. Surround yourself with people who are doing it or have done it, because their belief will inspire you, right? We can get confidence. We can borrow confidence. If we see somebody else has done it and they're confident, then we can borrow their confidence in us making decisions. So surround yourself by good people. Get a coach if that's in the cards for you, have mentors around you, and then just be patient with the journey. I remember going through, maybe the first 5 or 10 years, I remember thinking, man, this is so slow. This is like the slowest way to get wealthy ever. I wonder if it's ever going to happen. And then, looking back 22 years, I was like, that happened so fast. That was so fast. It just seemed like yesterday those rents were $300 a month and now they're $1,500. So, surround yourself with the right people, go to events, get a coach if you need help that way. And which, by the way, I'm coached by several coaches. And be patient with that journey, because there will be a moment, if you stay in the property long enough, that you turn back and you're going to go, oh my gosh, that was a miracle. That was a freaking miracle. But you gotta be in the property long enough to get to the miracle moment.
Yeah, perfect. Knowing what you know now, what would you have done differently on your journey?
I would have bought more properties after the Great Recession. I was really, really fearful because going into the Great Recession, my mom and my wife and I owned like 60 or 70 homes and small, like the eightplex and whatnot. And I was so afraid that I was going to fail my family and that I was going to crash this plane that I went to, putting $100 bills in my safe and buying gold and paying down debt. And I just really went into this armadillo phase of my life where I just, was covered up like this. And in hindsight, those were the most incredible years to be a real estate investor. And so that the old adage, be fearful when others are greedy and greedy when others are fearful. I did the exact opposite of that. And so if there is a pullback and I don't think home values are going to go up at 30% a year in Utah. They're going to slow down. There's going to be some deals out there. Rates are going to go down, but and that's probably going to happen in the midst of some sort of like economic tsunami, right? Something's going to break really bad in Europe, or something's going to break really bad in China. Like there's going to be some crazy stuff going on. But when those bullets start flying, those are the moments to fast forward your economic status. If you have a little capital and you can stay calm underneath all that fire and go, okay, great. Everybody else is panicking. I'm analyzing deals. I'm going to find me something in this moment. And so, I wish I had that time period back. I don't, but I do intend to be ready to take action the next time that one of those moments comes.
Yeah, no, that's great advice. And just to your point, not to step on top of what you said or anything, just to add to it. When COVID hit, I did two things. I fire sold a couple of properties because I was like, I need cash. Like it was a fearful moment, right? A few months went down the road and I was like, okay, like we're not going to turn into zombies. The world's going to be okay. and then I refinanced a couple of my properties into like, dude, I had a couple at 3.125, non-owner occupied for 30 years, fixed, like no balloons, nothing weird. And I'm like, 3% when inflation's like 9%. And we went from $1,700 a month in rent to $2,400 a month in rent.
Crazy.
And I'm just like, man, there will probably come a point in time where I just go, hey, let's get rid of the single family and go into something different. Because I'll have my equity spread will be so big. But for right now, I don't want to touch that debt because 3%, like I can't go out anywhere and get 3% right now. So it's true. And it's hard when you're in the moment to not be fearful when everything is like pointing like fear, you're going to die. You just because of how we're programmed. Right.
Yep.
And so, if someone else has been there, I'd say don't beat yourself up on that. Just learn. So when the next opportunity comes, you can take a step back and be like, okay, where's the opportunity, right?
100%. And look, every economic cycle is good. Once we wrap our heads around that and we know how to surf the wave, I've kind of explained it as, if you're a good surfer and the wave breaks right, you surf the wave right. If you're a good surfer and the wave breaks left, you surf the wave left. Like you just know how to surf the different breaks. That just takes some experience. Same exact thing in investing. If there's a recession, I'm refinancing, pulling out cash and looking to buy something when CNN has the banners saying, crisis in China or whatever, right? Like that's my buy signal. Buy, refinance to lower interest rates, buy. Conversely, when we have a booming market where interest rates are going up and I can't find something that makes sense from a cash flow standpoint, that's my indicator to invest in my properties that I already own and raise the rents. Raise the rent so that when we go into the next recession and I borrow against this asset, I have more cash flow and more value in the property because the rents are higher. So we just need to be able to learn from recessions or boom times how to play that or surf those conditions. And I think if we do that and we wrap our arms around that, like we should probably have a written plan. Here's what I intend to do in the next recession or crash, and write that down so that when it happens, we can come back to that written plan and have like some constitution there. And then conversely, here's what I plan to do in the next boom cycle when I can't find anything to buy. There is no cash flow because interest rates have gone up. This is how I intend to deploy my capital into the properties I own, or to save up my nest egg. But in absence of plan, we will just respond emotionally.
Dude, thank you for that, because I think that your last stint for a minute, that probably just made me millions of dollars. And if it doesn't make our listeners millions of dollars, like, they should go back and listen to it again, because it's so true. It's fight or flight. But if you have a plan and you're like, hey, if there's no deals out there, cool, I'm going to take some money and I'm going to go, increase the value of these units so that I can get an extra 100 or 200 a month in rents, right? Because that's going to make you more valuable in a 20-year period by having nice properties, by having, like, I bought a fourplex and I'm over here complaining that I had to spend almost $30,000 putting in 4 new HVAC units. Yet what I should be doing is going, hey, this is great, because I didn't know where to deploy that cash right now anyways. So I might as well take it from a $700 a month rent, which it was at when I bought it, to, I think we're getting $1,100 a month now.
That's
and
incredible.
They're 1-bedrooms in Glendale. Like, yeah. So I thank you. That's phenomenal advice, just on the cycle of real estate, right? Because there's definitely times to buy, and there's definitely times to be like, okay, well, market's super hot. Like 2020, there were still deals out there, but there were some people that were buying just to buy, and they were bidding, 20% over list price just to get a deal. Yeah. And those are the people that, they're going to end up underwater and lose money in the next 18 months if they sell. If they hold it 10 years, they won't. But yeah. So,
by the way, dude, if you just run that equation that you just threw out, you basically raise the rents from 700 to 1,100. Is that the numbers you said?
Yeah.
Right around there. So that's $400 a month times 4 units. That's $1,600 a month. You increase the rents times 12 months. That's an extra $19,000 in rental income. And if you divide that by the $30,000 investment, that's a 64% rate of return. Like, I'll take that all day long. And that's the way we need to start thinking is, if I can get a 16, 20, 30, 40, 64% rate of return, then I should be deploying my capital in my buildings to increase those rents. And I'm just preparing for the next recession, because the next recession comes, maybe my real estate or mortgage business, slows down or what have you. But now I have that increased cash flow, and I have an opportunity to refinance and pull more money out at lower interest rates at that time. So that's another key metric to keep in mind when to think about, should I deploy money in my properties or not? But that seems like a home run to me.
Yeah, solid. Well, I just never connected the two. I bought it. It was a little dilapidated, and I was like, well, one of the furnaces went out, and I was like, well, crap, like, we'll just replace them all. And it wasn't intentional. Like, I didn't run the numbers. I didn't know it was a 64% return on my cash, but which is way better than I think the 0.25% the bank was offering me to keep
it was a little better than that.
So, well, Josh, I want to be sensitive to your time. I really appreciate you coming on here. We've gone way over. So thank you so much. I enjoy getting to know our friendship, getting to know you more, building our friendship, and just everything that we can potentially do in the future. Just, yeah, it's going to be cool. Thank you,
bro. I look forward to seeing you on the trail next week.
Yeah, sounds good, man.
All right, buddy. Have a good one.
Okay.
Cheers, everybody. Take care.
Thank you for joining me for another episode of The Financially Free Investor. If you found value in this episode or know someone who would find value in this information, please share with them, subscribe, and send us a review.